Good morning and welcome to the Nedgroup Investments Quarterly Roundup covering the second quarter of 2026. Markets have once again reminded us that investing is rarely a straight line. Over the past few months, we've seen fast-changing interest rate narratives, elevated geopolitical uncertainty, and rapidly shifting market narratives. Today, we're joined by a number of our best-of-breed fund managers to discuss how they're interpreting events, where they're finding opportunities, and how they're positioning portfolios for the period ahead. Whether your focus is income, equity markets, or multi-asset investing, our goal today is to leave you with a deeper understanding of how our portfolios are positioned and, more importantly, why. We've got a jam-packed lineup, so without further delay, we'll get straight into it. Our first speaker is Walter Aylett of Aylett & Co. Walter, last year, if we look at the performance of the fund, we've seen a bit of underperformance come through. How do you think about that in the context of the fund's long-term approach and long-term investing?
Yeah, look, over its 21-year period, the fund has had sometimes quite long periods of relative, if you can call it, underperformance versus a benchmark of CPI plus 5. I think what's more important is not so much in the short term, and when I say short term, I'm talking 2 to 3 years, that it's not errors of commission, in other words, you've destroyed value, but more either errors of omission, in our case, not having the Magnificent Seven in the United States, and also it's our style. We tend to go to places where most other investors don't want to go in terms of short-termness. We're more long-term. I think we did make a mistake. It was in SPAR, and we were fortunate that we tried to sell as much as possible very quickly. We did lose a little bit of money. We still have a small position, but I think from time to time you're going to have these things beyond your control, and hindsight, it's always easy to discuss the problem, but I think it was just one of those things beyond our control. Management issues are very difficult to anticipate. The other reason why we had some underperformance, as you know, we've been an investor in Reinet for a very, very long time. They liquidated 80% of their portfolio. I think perhaps we were incorrect in expecting them to pay it out. Most fund managers wouldn't pay out liquidate their fund, and I suppose we have to be fair to the management team of Reinet. That said, I think we were also disappointed in that they didn't go and explain why they sold BAT at such an early time. And secondly, the valuations they placed on the insurance business was not conservative enough. So the money we got out of the sale was not really, we expected more in terms of what they've been telling us for the last 10 years. So the market hammered it, and rightfully so. And that hurt the performance, but there's no problem in Reinet. So we could have panicked and sold as well. That's not our style. I think it's just at the moment become a quasi money market fund in euros. It'll pay you 1.5% to 2% in dividends. There is some optionality in the other 20% of the portfolio. The good thing is, and this has been ignored, I think, by the market, is that they're now starting to buy back their shares, and they're physically buying cash at a 30% discount. So if you're patient, you'll be fine. And that goes, those two shares go some length, I think, to explaining the underperformance. And because we're long-term in our thinking, I don't think we've done anything wrong. We Buy Cars is another company that we have always been excited about. We could have traded it. It's not our style. What happened in We Buy Cars, they tend to grow. It's like a retailer. They're just adding more shops. And when you add more shops, in their case, parking bays to sell cars, you incur costs. Revenues only come 2 to 3 years later. And of course, we had this deflationary force with Chinese imported cars. Long term, we don't think it's going to hurt the business. And if you think that the car park has now grown quite substantially, that's what they do. In 5 to 10 years' time, your car park will be much bigger. You'll have more second-hand car sales to do. And so the combination of these three shares kind of hurt us, relatively speaking. I believe Renet will recover over the next year or 2, 3 years. Certainly, we buy cars, we believe it as a house. And Mondi is a new position that we put into the fund. So as a share goes down and you buy into it, you're going to have a negative performance. And we've been very careful on how we bought Mondi. And as it just got lower and lower, we've added more substantially. Jumbo, again, it's suffering from short-term issues in Romania, but the results are pretty good that came out recently. Jumbo is a Greek retailer, one that we know really, really well. I'm going to visit them in September. So I'm not concerned about the performance. I'm more concerned about making errors of commission. On the positive side, we're very pleased to see some very good investments in Netcare to come through. Super Group has done quite well for us. And some new positions, which are still a bit too early to tell, Aylett and Bidcorp. So I'm quite pleased with the fund. So I think that goes somewhere. And in conclusion, the best time to buy Aylett funds or Bravata is when it looks like we're not doing well, because our investments are getting cheaper, our ball is getting much bigger as in cricket, and we are getting more and more conviction, more and more evidence, and it's just being patient, something that is lacking in the investment world.
And these dislocations, of course, as you mentioned, providing the opportunity for you actually to increase your position and then those future returns coming through.
So going back to Renet, you can just see in this graph here what I'm talking about. We were doing really, really well. We've made a lot of money over 10 years out of Renet. Okay, so we had a blips. I think it'll come right.
You've talked about previously Renet, being in a place to park cash and giving you optionality. So you see some runway, as they unlock value going forward.
I think, to be honest, I expected them to pay us out. I see no reason why the management want to have 3 listed vehicles. It's onerous, it's time consuming, it's not nice being listed at all times. And I thought this one would have been delisted. My expectation was wrong.
Thanks, Walter. Another part of the fund, or one of the features of the fund that we've recently seen, is the increase in liquidity of the fund, which you described as dry powder. What opportunities would you need to emerge before you're willing to deploy that cash?
I think if you look over the last 21 years, my style of fund management has done really, really well in this panic in the markets. And cash gives you optionality. And at the moment, if you keep your cash in South Africa, you get roughly 7%, maybe 8% if you're lucky, to sit and wait. And I've tried very hard to try and push the cash up, but our underlying equity investments have also done quite well. What has counted against us, obviously, is as the rand has strengthened, you translate that into a negative return, which is part of the return of the fund. That could change over time. So I'm more interested. Why I'm particularly excited about fixed interest is that for the first time in our world for the last 20 years, we're starting to get higher yields in developed markets and our market. And whereas our market has a high real return, in other words, after inflation, we're not sure what's going to happen in that part of the world, but we are getting paid to keep our money in the bank now, or with treasuries or whatever. I'm not talking about long-term bonds. I'm talking about short-term money. So I think there is room now this is where Bravata, with its flexible asset allocation mandate, should use and take this to advantage. And I think as interest rates go up, the gravitational pull on valuations of all assets has to come down. So I'm just being cautious. I'm not calling it a crash. The more I read, the more there's too much being spoken about crashes, in my opinion. What I'm saying is I think you're going to get big sector rotation. You're going to get some kind of unlocking, some crisis. Something is going to surprise us. What it is, I don't know. And I think you have to have cash to be able to buy those things when the unknown happens.
And as a value investor, you do see growing, market speculative behavior in various parts of the world, especially the US. What do you make of that, and how do you compare that to previous periods, that you've seen in your career?
Yeah, it feels like 2008, 22, 2014 with the tantrum of Bernanke. you get these feelings, but what I've learned is trying to forecast these things is an absolute waste of time. I really thought 22 was, here we go, and we did. We were down 25% in the States, and then AI came through. I don't know the answer to that. What I do know is that you pay us to think about the unknown and to try and buy investments that are, whose value is not being reflected.
Speaking of value not being reflected, going forward, how are you positioning the portfolio and how are you thinking about a lot of the stocks in the fund? I think there's one in particular maybe that I want to throw out, but I'll get to that.
Yeah. No, I think, first of all, South Africa has been quite good to us as an investment environment over the last 2-3 years. And I don't mean gold shares. I think we bought some good industrials. We bought banks earlier on that we sold, perhaps too early, as always. But I think the shift is more into more stability. I would prefer to see more cash in the fund, and every time an equity or an asset hits the valuation you sell, there's a natural drift then to cash. And I think, as I've said in the past, you're going to see us move more towards Asia than the West. I think the Western world, particularly in US and Europe, is very challenged in terms of population growth, particularly in Europe, other forces, inflation. One thing I learned in my travels is everyone says they can't find people to employ in kitchens or contractors, certainly in Europe, and even in South Africa. That's why we have this huge group of immigrants that live here. And in the States, I think you see the same thing happening there. When I looked at the job numbers, they're not as bad as the States is actually quite an interesting place, and that is confusing. There's a lot of confusing macro stuff. And so when I can talk about the Magnificent Seven, the whole world talks about it. I think it's more about the long-term consequences of what's been employed in the States. So I think it's natural to go more to a world where I think people get on with it, their governments are in control, and they do the job, and that's why we like Asia.
On that note, how are you positioning the portfolio? Maybe walk us through some of the asset allocation.
So in the beginning, we always were favorite. If you go back 20 years, you talk to the old timers at Nedgroup, we were always bullish on Japan, which just simply got out way too early. Look at where it is today, although the yen has hurt you. I think what we are trying to do is, we started small. We've got a chocolate company in Indonesia, which is listed in Singapore. We've built up quite a nice stake now in a casino called Galaxy, which we can talk about later on, and then also Budweiser Asia. So gently building up this portfolio. And then in our stake in the Aylett Global Equity Fund, they've been quite active. They've added, I think, 1 or 2 new names to Asia that we wouldn't buy, and that's quite nice for me, is that the youngsters don't have the scars that I have, and they put in their batting and they're on their front foot, which I think is brilliant, and they are making money. So I think that's what's tilting us. And then this thing of going back into fixed and pushing the fixed interest portfolio, trading it. We've been quite active in bonds in South Africa. I'd like to see more of that offshore. And then it has to come from somewhere, and it's equities.
So you've been downweighting equities in favor of
I don't
bonds.
Start to think of that. I just naturally come to a level where I'm comfortable to sell a share, and ask myself, can that beat the bond market?
Okay. You mentioned one of the positions you've been building is a casino in Macau. I think that's quite interesting. Maybe give us your thoughts on that.
Yeah, so what I like about, I'm not a fan of the gambling world. I think it's a really hot potato at the moment, particularly in the unconventional gambling world. You think of the prediction markets and really the speculative markets. But I think what I like about China, they know the dangers of the gambling industry. They've put a big fence around it, and there are 6 licensed operators in Macau. We used to favor 2 operators, but I was very uncomfortable in terms of our mandate, which we don't like losing money, that Melco, which has got more upside than the others, I prefer to buy Galaxy, which is a strong balance sheet, tons of cash on it, and also has a growth profile which I think is better than the others in that it's adding more properties. So those numbers have still got to come through. So even if the gambling market tapers, you get some upside. And the markets have been quite weak there. As you know, the Chinese economy is struggling, and you're getting these wonderful assets like Budweiser Asia. I met with management in June. It's not, no one wants to buy beer, you know, because they're more in the on-sale market, which means you're in the bars and the nightclubs, and you have to be in the off-sales market, which is more bottle stores and all that. So they have to make that shift. And they've got a bit of Vietnam and India, which is kind of an option. It's far away. So I think as we build that part of the portfolio, and find another stock and another stock there.
Yeah, I mean, as we know, the fund, you know, it doesn't change often.
No,
but
thank God.
Yeah, but one thing we can count on is the very differentiated portfolio that you put together. So if we look at some of the names in there, you know, maybe just give us a roundup of maybe of some in the top 10.
Yeah, well, first of all, I like our global equity fund, and it's not because it's our fund, but I like the way the fund manager has focused it, concentrated in the three sins, if I call it: gambling, tobacco, and alcohol. Alcohol's a tough one, but I think they're going to win that one. And then we've kind of doubled up on those bets ourselves, so on a see-through basis, plus what we got. And then I like the fact that we have more of a, I don't think we're that different, maybe only one or two shares. I like Adidas. I think it's winning the game against Nike, but it's still too early to tell. Netcare, I think, is a great asset. I mean, I wish I'd put 10% of my money in Netcare. They're just doing all the right things. BAT, I think, is going to surprise. I mean, these, what we call modern oral, which you put in your mouth, and there are many countries still that don't allow that. And that market's still like France. And I think that's going to boom. And then I do like our asset managers in St. James. There's some negative news recently. And N91. I think that team is just going to carry on doing well. The risk is they're high beta players. But yeah, I think we're going to have less equity and more income producing assets like bonds. And when there's a bust in the corporate market, we'll buy there as well.
Waiting again for once again that dislocation to come through.
It's you know, Charlie Munger had that wonderful way of saying this: sit and be patient. And as I say, I don't believe markets are patient. You know, there's just, you're not rewarded that way. It's a very lonely place to be patient. What I call career risk, we're very high in career risk, which means we do what's right for clients and not for Aylett and Co. And you can lose your assets by doing the right thing for your clients, which sounds bizarre.
But so as we know, yeah, patience is really one of the last competitive advantages I think that fund managers actually has, right?
I'm very patient. I've learned over, 30 odd years that the one edge that I have, and it sounds arrogant to say that, but I'm very patient. I really, really am quietly confident in the abilities of the people that I work with, the assets that we employ. A lot of our own wealth is in these funds, so what more better recipe for success? You know, you're not looking over your shoulder, you're making intelligent, rational investments. I think we'll do just fine.
Indeed, all the qualities we look for in best-of-breed fund managers. Yeah. On that note, Walter, we'll leave it there. We thank you so much for your time and insights today. We really enjoyed it. Thank you.
Yeah, thank you.
Thanks, sir.
Cheers.